So a few weeks ago, organizations involved in the digital asset space started to realize that the infrastructure bill had misdefined the term broker in proposed amendments to IRS Code 6045C that will expand reporting requirements beyond what even the drafters themselves had intended. Why the commotion? It was poorly considered, and it was not subject to any kind of educated or reasoned debate. Despite its unintended consequences, the whole way it was inserted into the bill was designed to force passage without deliberation, as we all saw. Fact is, most of the members of Congress don't understand how this will affect commerce in the years ahead and are, frankly, too apathetic about it to care. Has my pet project been covered? Aye. In fact, the issues with the revisions to the IRS code in the infrastructure bill go deeper than simply the definition of a broker. And this is something that Abe Sutherland identified early and started raising a few weeks ago. What Abe Sutherland saw is that additional revisions to IRS Code 6050I raise new issues in a way that was also never contemplated and was jammed into the bill. He realized that 6050I ran directly contrary to the ability of every American to ultimately realize the benefits of a more efficient payment system, and it would unnecessarily impact Americans' privacy and autonomy in the name of tax collection and in the name of an antiquated pay-for provision that is used to theoretically offset unbalanceable budgets. This episode is one that you shouldn't miss. Of course, you're on it now, so you're not missing it, but you should also make sure to share it with your colleagues, people you barely know on social media, your friends. I'm not going to say that I hope you enjoy this episode, because actually, I don't want you to. I want you to be disturbed by it, because this is what's happening right now. Welcome to The Encrypted Economy, a weekly podcast featuring discussions exploring the business, laws, regulation, security, and technologies relating to digital assets and data. I am Eric Hess, founder of Hess Legal Counsel. I've spent decades representing regulated exchanges, broker-dealers, investment advisors, and all manner of fintech companies for all things touching electronic trading with a focus on new and developing technologies. So this is Eric Hess with The Encrypted Economy, and today I'm really excited to have Abe Sutherland, founder of Sacker Group, on the podcast. In addition to being the founder of Sacker Group, he is also an adjunct law professor. He's written extensively about policy and tax policy. Abe, for starters, welcome to the show.
Thanks. Good to be here.
So I started to touch on it, but could you give a little bit about your background before we get into the podcast?
Well, I'm a lawyer, have done different things in the law, and came to cryptocurrency a few years ago just as an interesting place where the full implications of this new technology and how to fit them into our existing categories hasn't been worked out, and the consequences of these decisions early in this process are really important. And where things are in flux, that means there's opportunity and a lot of consequences for getting it right.
Great. And I warned you in advance of the podcast, personal experience that shaped your values or your worldview.
Wow. Well, I don't know how far to go into this, but something really on my mind recently. I spent time in Afghanistan with the State Department, and over these past few weeks here with the events with the Taliban have been deeply on my mind. So certainly that experience working with Afghans in Afghanistan and seeing how this is playing out now was certainly formative, and it's certainly on my mind. So I'll offer that.
Well, definitely could see that. So let's start to talk about your recent posting on 6050I and a lot of the work that you've been doing in talking about this provision that was jammed into the infrastructure bill. Now, a lot of people who are listening to the podcast may be very familiar with 6045C, which was the provision that the whole crypto industry rallied around, basically surrounding this definition of who is a broker and the potential for it extending to miners and even developers. Treasury Department said, no, put it in as is. We won't really touch it. It got skedaddled, it got crushed at the final hour to trying to broker a compromise. And there's talk that the House of Representatives is just going to jam it through without any revisions. But maybe a little bit of background on the congressional pay-for provisions, which you've spoken about, Abe, before we start getting into 6050I, which is something that's been overlooked.
Right. So what we're talking about here are provisions in the infrastructure bill, which are technically there, as you mentioned, pay for, which are designed to help address and offset the expense of the spending anticipated in that bill. And as you mentioned, fortunately, it did get attention, these so-called broker provisions under an amendment to Section 6045 of the Internal Revenue Code. But what brings me here today and attracted my attention was a provision that basically seemed to be overlooked in its consequences, which is an amendment to a different provision of the code, Section 6050I, which is quite different from the broker provisions, and is something I think just really needs to get some public awareness, especially as we rush through with this infrastructure bill.
Right. And just to put some further context, today we're hearing about that the Treasury Department is seeking broader powers to be put into the infrastructure bill that would allow it to share information collected with foreign governments. And they want to include that in the infrastructure bill as well. This is all developing story, but the context is some of the points that we're going to talk about today with regards to 6050I obviously also has implications in the context of how the information captured can then be shared beyond just the Treasury Department and the IRS. So with that, so the issue with 6050I, do you want to give us a little bit of the backdrop on it?
Sure. So 6050I, or let me start with the amendment to it. The amendment is extremely brief. It's just a few words. And what it does is it points to 6050I and it says, in this particular statute, the definition of cash, which generally in that statute means physical currency, coins and paper money, a few other exceptions, is expanded to include digital assets. And I mention that because it's perhaps part of the reason why it has failed to garner more attention is it's such a simple, small change to this statute. So we have to understand what 6050I does. What is this statute? It's a provision added in 1984, and it's designed to reduce the incidence of large cash transactions, or more generally to require record keeping and reporting of large cash transactions, specifically those over the threshold of $10,000. And what it means is anybody who receives $10,000 or more in cash in the course of their trade or business, and we're going to come back to these different elements, is required to report it. And that means fill out a form. It's currently known as Form 8300. I actually encourage people to go look online and look at what Form 8300 is, and report to the IRS and to report to the government the details of that transaction, specifically including the personal information and social security number, name, address, profession, and other information concerning the person from whom they receive the money. So this is a general provision which applies actually to any person that receives cash over this threshold in the course of their trade or business. So what this does is by adding digital assets to the definition of cash, it imposes a very serious reporting requirement on all Americans, all American businesses, and anybody acting in the course of their trade or business to obtain, indeed verify, and promptly report the personal information of the person that they received these digital assets to the government.
So I guess one question is, today, a lot of this reporting occurs seamlessly without us knowing about it. Do you want to kind of expand on that and why this sort of hits the digital assets more directly as opposed to, what occurs in the current modern day economy?
Well, there's a couple pieces to this, and I'm going to come back and talk a little bit about how this statute exists. Most of us aren't aware of it or only vaguely familiar because, after all, most of us aren't transacting in $10,000 cash increments, in part because of this very statute, which makes it expensive and adds a lot of obligations to those who might accept large amounts of cash. But what we got to focus on here is what this means in the context of digital assets. In the context of cash, we got to look at this statute. The assumption with cash, of course, is that this is a person-to-person, face-to-face transaction. And that makes it at least feasible for the person receiving the cash. And remember, this is an obligation on the person receiving the cash. It's not the person sending it or paying it to the other. This kind of fundamentally in-person nature of a cash transaction makes it feasible for the person receiving it to insist on verifying the person's identification and completing and gathering all the information that is required to be reported on this IRS Form 8300. Digital assets, of course, are not cash in this way. They are not in-person transactions. And indeed, the potential and the promise of digital assets is not simply to replace the use of cash. It's more to offer an alternative and a whole new technology-enabled possibilities that more compete with or might replace traditional bank and other financial institution-mediated transactions. So the challenge we're facing is we have a Stone Age statute, kind of for old world of dealing with physical objects, being asked to apply to a new technology, which fundamental to it is the ability to enable these transactions, again, when you're not face-to-face, and to do things that heretofore, at least in recent history, have required the use of a financial intermediary. And this is one reason why this provision ends up being pretty complicated, because it only makes sense against the backdrop of existing financial regulation. And that brings us into the Bank Secrecy Act and the numerous provisions there which already exist that provide the IRS and the government with visibility on financial transactions. In this case, the argument for this is tax collection, because when you have a peer-to-peer transaction, such as with physical cash, there's a possibility of it not being reported. But when you have an intermediary or somebody else that is required to report it, just think generally about banks or financial institutions, there is visibility, and it reduces the opportunity for underreporting of income and tax problems.
And so is this fundamentally a taxation issue, or is it fundamentally a reporting issue?
Well, the tax receipts are the hook on which this provision exists. And this does get complicated because there are other provisions and similar provisions in the Bank Secrecy Act are rooted in both tax considerations, but also kind of more general crime fighting provisions, concern over money laundering, concern over counterterrorism efforts and terrorism funding, but it's a reporting provision.
And does the reporting provision itself impose a tax of its own?
No, not at all. This is simply to ensure that the government has the information to enable investigations, to compare against one's returns filed, and so on. So this does not change the substantive tax of anything, which is important, right? The tax law is the tax law. If we're talking about digital assets, when you realize gains, those are subject to tax. That there's nothing changed here. It's a question of government access to the information to ensure compliance and to reduce the hiding of assets or underreporting of income.
So is this particular provision necessary for the government?
Well, look, this is a deep question. I think it's important to look at this in kind of two steps. One is the nature and the way that this provision has ended up already passed by the Senate and now pending in the House, and to flag these issues which require more discussion. I have strong opinions on this. I think it should be absolutely back to the drawing boards. And we need to do these calculations and make people be upfront about the costs and benefits of this. So I'm very critical of the need for this, but in a more immediate fashion, and certainly an argument that I think should get general support, is that this is absolutely not the way to proceed with the new provision to have it escape scrutiny in an infrastructure bill without full appreciation of its consequences. And again, the reason its consequences aren't clear is because we're using a very old statute to do something to an entirely new technology that really doesn't match up. So this is what I'm trying to help spell out, or at least give the fundamental parts to it, because I think it needs attention from others who are attuned to this type of regulation to help begin to spell out those consequences, so that at the very least we can have a realistic debate here. Because maybe now, Eric, I should kind of turn to an overview so people can get an appreciation of what triggers this requirement and what the consequences are. First, let's see which to do first. I want to talk about the consequences, kind of get people's attention. This is a criminal statute, so violations can result in a crime. Prison time is possible. And the requirement is to file the information requested under the statute and through regulation to the government. And right now that's within 15 days of a receipt of cash, or for what we care about, digital assets. And a failure to accurately and promptly file that can lead to fines or even criminal penalties. So there's the obligation. Now the question is, well, what could trigger that? And why is this such an expansion that we should be worried about it? Well, again, we have to reference to the original statute, which has to do with cash. In that case, upon receiving cash in excess of $10,000, you have 15 days to fill out this form. And that includes a requirement of verifying the persons from whom you receive it, their identification. You take down their social security number and you file this form with the government. You then need to keep that information on file. And at the end of the year, provide an annual summary to each person that you reported. And then you also need to keep all of these forms in your files for a minimum of 5 years after that. So what happens when we apply this trigger for reporting to digital assets? And there's a couple elements to it. The first is a receipt. And I want to focus on this because I think to the extent people look at this, they say, well, if we look at the cash example, this means, if you're accepting cash as payment, it's income, it's revenue. Receipt is not defined as revenue. It has nothing to do with tax liability or what your tax consequences might be. It's simply a receipt. And of course, with physical cash, that's relatively clear and relatively rare. But with digital assets, a receipt is much different and presumably means anytime digital assets, and we'll come to the definition of that in a minute, are received and made available to you in an account to which you have control through private keys or otherwise. A receipt has nothing to do with taxable income. It could be the proceeds of a loan. If you receive a loan, it could be the repayment of a loan, something that was already yours. So it's triggered simply by the receipt, and it may have nothing to do with your net position once you pay it forward. Just to give an example, in the old world example that will make this clear, an exchange of physical cash for other cash can trigger the statute. So if you had $15,000 of cash and you traded it to me, you had small bills and I had large bills. I received in that transaction more than $10,000 in cash, and so did you. And we would both be under an obligation under existing law since 1984 to report each other's social security numbers and the nature of the transaction within 15 days. So as that illustrates, it has nothing to do with potential taxable income. It's more broad than that. And
there's one really important point about that too, which is if we exchange the 15,000, there is no electronic record of that having occurred. There's no footprint. So people could be not in compliance and no one would ever know, and no harm, no foul. But with digital assets, when that occurs, there is an electronic record of that. And so if there isn't a reporting, it could have very real consequences.
Right. Well, I think what I'm hearing from that is it's pointing out an asymmetry, which makes the urgency of reporting all of these less intense because of the potential for kind of an auditing trail or something. And I think that's a good point. And that's exactly the kind of thing that should be discussed as people kind of spell out and weigh out the full consequences and range of scenarios where this will occur, because that's exactly right. With cash, the assumption is there's absolutely no tracking ability. And that's certainly not the case with digital assets. So we've talked about how broad the concept of a receipt is. One, we can kind of continue to go through the elements. Another one is that it only needs to be reported if the digital assets are received in the course of a trade or business. And I think this is another reason why it hasn't attracted the scrutiny. People look at that and they say, okay, if you're a business, if you're Elon Musk accepting Bitcoin for a car, then you're in a position you need to report the buyer's social security number and stuff. But hey, that's in a trader business and that doesn't apply to us. But the concern here is that the trader business limitation is not necessarily nearly as broad. It does not provide the safe harbor that people expect. Because first of all, what counts as a trader business is somewhat vague. It's not defined in the statutes. It's subject to judicial interpretation. And a lot of activities can be trader business. And once you're in a trader business, anything received in the course of that would also qualify. So to give kind of an old world example, if you sell your used car for cash, $10,000 in cash, you may not need to report that because it's not received in a trader business. But if you were to sell your used work vehicle, that would be in the course of your trader business and would need reporting. And with digital assets, so much of what is done, whether it's mining, staking, or lending, and in some cases simply trading, can be a trade or business. And that means any assets received in the course of that activity are receipts under the statute. That leads us to the next element of this, which is the $10,000 threshold, right? So this only applies, starting with cash, for transactions over $10,000. But in fact, the transaction is defined very broadly, and it includes related transactions, and it can include payments relating to a single transaction. So if I lend you money, even if your payments to me are far below $10,000, those are all related to the same transactions, and therefore they need to be counted and added up over time. And then the reporting obligation kicks in as soon as the total adds up in the course of a year to over $10,000. And then it continues to add up and require a new reporting obligation each time it reaches $10,000 again. So if I were to lend you $50,000 in digital assets and you made periodic payments back to me, again, assuming this is in the trade or business, that would trigger the requirement every time that your payments totaled up to $10,000. So the point I'm trying to make here is that a requirement which in the old-fashioned world of cash may not be too serious, or it's easy to track simply due to the inconvenience of cash, can and will be triggered much more easily in the world of digital assets.
Right, with ramifications that haven't been thoughtfully considered because it's been jammed into the infrastructure bill.
Exactly.
We talked about the dichotomy between digital assets and cash and how that has different ramifications. We talked about the difficulty of even complying with Form 8300 for a lot of digital asset businesses because it requires a different bureaucratic structure that's designed for the old world and not designed for digital assets. Do you want to double click on any of those implications or lay out a couple of more?
Yeah, let's think about this. Yeah, I mean, some of these things bear emphasis because they're so obvious, but they're important. This requirement assumes a connection to the person who. It assumes two things. One, it assumes it's a person transferring the assets to you. Now, remember, one of the problems that were raised with the other provision that did rightfully get attention was the question of, hey, this might be impossible to comply with. People might be obliged under sanction, penalty of under legal penalty to report information they may not have access to, and we have that same potential with this statute because the statute assumes not only that you're receiving these digital assets from a person, but that it's an identifiable actual human who is providing that. So we still have so point number one is we have fundamentally a possibility. What if digital assets are received from some type of algorithm? How is compliance even possible? Now, and this gets to the question, and as you mentioned earlier, we might have the Treasury Department come forward and say, "Oh, don't worry about that. We'll be realistic here." But we have to look to the terms of the statute and also to the existing regulations to get a sense of how this might work out. And as a matter of a new criminal law provision, it's important for this stuff to be clear. And so, my argument there is, assurances are not enough. We need to address these things at the level of, before we put them into law.
Because they have fundamental policy implications too, particularly given that we still don't know how the script is going to be written 5 years, 10 years, 20 years time when nobody's demonizing the Wild West in crypto. And this is just part of everyday commerce.
This is a critical part of the argument, but it's a very difficult one to make, in particular to people who may not be deeply familiar with digital assets. And that's to attempt to quantify and raise a flag about the collateral consequences, the unintended consequences of a provision like this, in terms of its effect on the industry as a whole, America's potential leadership, and the consequences for what it will do to discourage activity in digital assets. These are very hard to quantify, but these are the types of questions I'm trying to raise so people can debate them, ask questions of legislators, and try to kind of have an informed discussion of all the unseen consequences of something this dramatic.
Right. And some of the other implications that concern me, having spent a fair amount of time on cybersecurity and privacy as well. One is who's ever collecting this information, there are various touch points, particularly if it's being shared internationally. So arguably, there is a honeypot of information. This exists today, but is only going to be growing exponentially under the statute if they're successful in collecting this. And the question is do we keep forging ahead and saying, we got this, without contemplating what it does to the sheer volume and how, particularly if you're sharing, how it's actually going to be protected. What's the plan to scale the security? What about post-quantum security? What about homomorphic encryption?
Yeah, excellent points. And we're already dealing with these with existing financial institutions. And there's a kind of a parallel debate going on under the Bank Secrecy Act and related provisions about the consequences of requiring this information collection and storage and reporting. But this opens it up again on every and any American, certainly any American business, and then any individual who's acting in the course of their trade or business. So suddenly, this requirement, which requires obtaining sensitive personal information from those one interacts with, social security number, nature of transaction, details like this, and requiring to store that and share it with the government. The consequences of this data collection and storage requirement, again, being imposed broadly, not just on already regulated, highly regulated financial institutions, which are required to have systems in place. The consequences for that, for simply dissuading the use of this technology, and the next level down is kind of thwarting its potential and, again, driving use back through these institutions, these financial institutions, these existing intermediaries, which are specialized in this, which directly challenges one of the central propositions here is that there's a better, cheaper way to do this, which can reach more people at lower cost. And the effect of these provisions is to make it that much more expensive, that much more risky, impose these privacy-related concerns. And a clear effect of that is to privilege these existing intermediaries and financial institutions, because who wants to comply with such an extraordinary burden?
Right. I mean, I've advised a lot of companies on cybersecurity, and sometimes in a negotiation, there'll be a provision that says, "Oh, you're going to take all these different privacy measures with regard to any personal information we give you." And if there's any possibility of that, if there's no possibility of that, I often push back hard. And then I say, "No, you have to rep to me that you're not going to give me this information because I don't want the burden of having to protect it. I don't want you to poison my client with PII." And so with a lot of digital asset protocols, they don't take in that PII. It's so the danger isn't there. It's fully encrypted. It's to a wallet address, and there isn't the issue with PII. So particularly as it relates to smaller transactions and in the normal course, the question is that burden worth it when now it not only imposes this additional reporting obligation, antiquated as it is, but now it also forces that business in the position where they have sensitive information, and presumably they can't just wipe it, because what about there's an error in transmission? What about if the government comes back? They also have to report it at the end of the year. So now they're forced to retain this information, and it brings in a number of different statutes. There could be a GDPR implications if it's a European resident. There could be CPRA under California and a slew of other state privacy statutes that are coming into fore. And obviously privacy is important, being protected around the world, but now you have this for digital assets, and the implications could be that you now need to have an entire privacy infrastructure in addition to the reporting and tax and AML infrastructures that all this entails.
Exactly, and I think that's helpful for illustrating the effect of this on kind of the existing system and reliance on intermediaries, which the government relies on for the majority of its information reporting, right? Because, and let me use another old world example. If you and I are two shopkeepers and you want to, let's say you want to pay me in cash, $15,000 in cash, and I want to receive cash. Well, if we're going to do it under existing law, I've got to fill out Form 8300, and I've got to get your personal information. I've got to store it. I've got to give you an update at the end of the year. I've got to keep it for 5 years. We have to go through all of this PII process. Or we could just walk to a bank, right? And you could hand them the $15,000 and then they hand it to me. And then I don't have to do this job of recording your information and raising all of these privacy and data maintenance issues, right? Why is it that avoids the problem? Well, it avoids the problem by going to the bank because of completely separate regulations under the Bank Secrecy Act, which means that the bank is going to perform that equivalent surveillance and reporting. They're going to make a record of that $15,000 received, and they're going to make a record of that $15,000 sent. And they're set up for that. And more or less, we accept that tax reporting regime. And I give that old world example to emphasize the pressure that this will create to reintroduce intermediaries. Why would I accept digital assets from you if there's a chance that it might total up to $10,000 at some point, and if it does, I'm in a position of needing to somehow verify. So it's, again, unclear how that's even possible under the statute with digital assets, and maintain your personal information in my files when we can go back and rely on old-fashioned intermediaries. The whole point of this technology is to reduce our reliance on them.
Right. And I think one point that you raised is that when the statute was, first passed, the $10,000 was equivalent to $65,000 today. So it hasn't been adjusted for inflation. So at a very minimum, it potentially puts burdens on a far lower threshold of cash in real dollar terms than was ever intended initially.
Right, and these are all important points that need to come out in the debate. This well-known $10,000 threshold dates to 1970 under the Bank Secrecy Act, and roughly back then that would have been about $65,000 in today's terms, and that's slowly gone, kind of been eaten away. But that's another thing that isn't much under discussion, which is to really look at the costs and benefits even of these different thresholds, because that's a very different figure, $10,000 in 2021 than it was in 1970 or even in 1984 when they used that same threshold from previously and brought it into this provision, which again doesn't just apply to banks; it applies to any person, any American who's receiving value in the course of their trade or business. Maybe we should talk. We haven't even mentioned kind of the definition of digital assets that we're dealing with here. The statute is remarkably broad. It applies to digital asset is defined to any digital representation of value that exists on a distributed ledger technology. Again, and then with additional authority vested in the Treasury Department to kind of define that around the edges. This definition of digital asset, of any digital representation of value, goes far beyond the use of straightforward cryptocurrencies. Digital asset is much broader than that, and in effect, it's bringing in transfers of value in any form that exists on digital asset technology. And this is important because, again, it's not just payments that we're talking about, it's things of value. I mean, the receipt of non-fungible tokens that have a value could trigger this. And that also illustrates how this moves beyond just the world of payments of value for other things. Digital assets are their own thing. And the exchange of digital assets qualifies. So if you and I were to make a trade of something defined as digital assets under the plain text, we would both be in a situation of needing to verify each other's personal information, store it, report it under threat of criminal penalty.
And it's interesting, last week or an earlier week, I had a podcast with Matt Zan, an author of a book on Hyperledger Fabric and very plugged into the Hyperledger community. Great podcast, talked about smart contracts, a number of things. In the podcast, I asked specifically was if there was any kind of awareness of the impact of the infrastructure bill on what occurred within Hyperledger, which is a private blockchain network. His impression, of course, he doesn't speak for the entire Hyperledger community, was, well, it doesn't really apply to us. It's structured differently, blah, blah, blah. But I'm not picking on Matt because he certainly knows this stuff very well. And I didn't bring him onto the podcast to talk about crypto tax law. But in fact, it's not really limited to, again, this notion of Wild West crypto. It extends to Hyperledger. If you have why is there an impression that it's limited to crypto? Only because crypto has been most vocal. But in fact, the implications for private networks and P2P transfers within those private networks that some of the, Fortune 500 companies are supporting on Hyperledger or Corda or whatever private blockchain network gets developed in the future to interact with the public blockchain or not, those transactions are similarly impacted. And there is no exception for it. As you noted, that definition of digital assets is very broad-based and it captures that as well. So the full impact of this, in fact, hasn't even been recognized by the crypto community, which is one of the reasons we're doing this podcast. But the full implications of it for even private blockchain networks and how P2P transactions occur on private networks hasn't even been discussed or debated or acknowledged.
Exactly. And this is what people need to explore. And hopefully we can get people looking at this, because there's all these examples that I'm not an expert in, but should be raising people's attention. Look, a fundamental feature of this technology is to allow kind of near instant, low-cost clearing of transactions in ways that don't necessarily have analogs in traditional finance, but especially not with cash, right? And again, this comes back to the requirement of a receipt. There's no netting, net receipt element to that. It's a receipt. What if you receive, 10,000 payments or 100,000 payments of 3 cents a piece as funds are moving back and forth, as things are immediately cleared and settled and remained in equilibrium with another party? That could trigger the statute, even if the net effect of those payments is zero or very small. So my sense is there's an entire universe of consequences to this statute that we need to expose that really get to the potential and I think even current use cases for this broad category of digital assets.
Right. And I also think it's somewhat ironic that most Americans would view what China is doing with their CBDC as giving excessive governmental control and visibility over citizens' financial dealings. But this is sort of passing under the radar. Do you think that's a little perverse?
Yeah, it's very strange. And it's interesting because, to be a little provocative, at least in a system like that, only the government might have access to it, right? Because we're not moving directly in that China direction, this provision adds an interesting wrinkle where we're actually enlisting our comrades and fellow citizens to monitor each other and exposing each other to that information, right? It would be one thing if we had kind of the Chinese model, for lack of a better term, of a blockchain with complete transparency, at least for the people with the right to know, and some level of day-to-day privacy for the rest of us. But this step is very interesting because it introduces all, not just financial institutions, but potentially all businesses and all Americans into that role of monitoring, keeping, and reporting on each other. So it is ironic.
And introducing friction. I mean, one of the things that I'm sort of struggling with is that, there's a lot of hammers being given to regulators these days. The Gensler's looking to grab his hammer, Treasury's grabbing their hammer. And when you're a hammer, you're looking for nails, but there's very little consideration about what it actually is doing to the ecosystem. And hey, how do we actually harness this innovation in a way, and how do we be thoughtful about deploying it in a way that doesn't kill the space, that allows it to proliferate, that allows the U.S. to become a source for the innovation in the space versus, crushing it. I mean, for the U.S., the U.S. has the monopoly on the dollar, and if it wants to maintain dollar dominance, I guess one way is to try to control the world and force everybody to sort of obey to this reporting structure that makes it hard for anything to occur outside. But I think history has shown that doesn't always work out so well.
Yeah, and your metaphor of the hammer. I mean, the way to think about this, or the way some people think about it, is the comparison of physical cash and cryptocurrency. Some people kind of accept that analogy, that they're in meaningful ways equivalent, but I really want to challenge that. And it's an important issue because if all you're concerned about is tax compliance, you can see why there's an apparent similarity there, because the feature shared by cash and digital assets is that they can move from A to B without the involvement of a financial intermediary, which is already authorized to observe and report the transaction, right? And there's your hammer scenario. You look at this, and that's all you see is this similarity. But that's a mistaken view of digital assets. They're not simply a payment mechanism analogous to cash in that respect. They have other potential, but describing that potential is difficult and it's hard to educate people on. And so that's why we have everybody looking and using this hammer of Section 6050 to apply to something that is so much broader, and the implications are so little understood at this point.
And so it looks, unfortunately, that there wasn't much success in the Senate, although we did, when I say we, the crypto space writ large was able to sort of raise the issue and have it more debated, even if the debate ultimately didn't achieve what it should have, and it was just passed and said, if you want your Senator Shelby, if you want your defense appropriation, I guess we don't get what we need, and it goes through. So what happens next if, in fact, it is passed by the House and it goes back to the Senate and finally approved?
Well, a couple of thoughts. First, we're all in for a rude awakening as the regulation promulgation process starts and the consequences of this sink in. Okay, so that's to answer your question. What we're in for next is, as Treasury sets down and say, okay, how are we going to administer this new requirement under 6050I? and the extent of the Treasury Department's power in limiting or making it feasible to comply is going to come in, and we're going to see a prolonged and huge debate with a lot of kind of lobbying around the edges to make it at least feasible to comply. But I want to make another comment on general. Like you say, maybe it's a foregone conclusion in the House. I don't know what's exactly where things stand there. But one cause for optimism, or something like optimism, is I was actually quite impressed with how the issue in 6045, the broker provision, managed to achieve some kind of salience with the public, not just the cryptocurrency sphere, but with legislators and others about its consequences. That's actually a pretty complicated argument, right? About kind of the nature of broker provisions. Those are far more removed from the day-to-day life of most Americans. That's why I'm emphasizing this provision. I think there's an opportunity here. The consequences could be much more salient if people appreciate them, right? This is a provision that applies to every American. Yes, there's the thing, it has to be in the course of your trade or business, but that does not provide the safe harbor people think. And it's a requirement that will put Americans in the position of collecting and storing and obtaining personal information of others and reporting it to the government. And I think once the consequences of that are a little better understood, the kind of the political saliency of that imposition are even clearer than they were with Section 45, and have the potential at least to provoke the debate, right? I know where I come out on this debate down the road. I think it's not feasible to do this, but at the very least, we need to have that debate. And I think we can get there if people understand the full implications of this.
And do you think that 6050 perhaps resonates more on the policy objective of financial inclusion?
It certainly does, but some of these arguments, they've kind of faded from public view. I think that's unfortunate. It certainly can, but to understand why, we have to go through the steps of what this means for real people in the future, and whether this provision is going to is going to lead businesses and institutions to play it safe and avoid peer-to-peer transactions, thereby privileging and pushing back through financial institutions these transactions, which are supposed to be enabled to avoid that entire level of cost and centralization. So yeah, there's work to be done on kind of making that point more salient, because it's complicated, but I certainly hope so.
So I'm asking you difficult questions along the way, and I'll ask you one last one. Why do you, like in this case, obviously this was jammed in as part of the overall infrastructure bill, but why do you think provisions like this end up getting put into law?
I mean, if you take a step back and view and it requires some overall perspective, I think, on kind of the status quo today in the early 21st century about the steps in place for the IRS and the government in general to maintain awareness over the financial transactions of citizens. And again, this is something which is relatively removed from Americans' day-to-day lives, but it's an important story to understand the extent to which the institutions that have evolved over centuries have been used really, you could say in the last 50 years, have become an increasingly relied upon for this purpose of tax collection and general crime prevention, right? Banks did not evolve specifically to allow governments to keep tabs on transactions and to keep people safe and maintain tax revenues. But they were very convenient for that. And what we're seeing now are efforts in order to maintain that grip on information to enable full tax collection and crime fighting, a reluctance to this new technology that has the effect of pushing us back and increasing our reliance on these institutions. So, that's complicated stuff, but I think that kind of big picture is important to understand what's going on here and to understand the effect of a provision like this by imposing, unlike these other provisions, which impose new responsibilities on existing intermediaries for information reporting, whether it's banks, financial institutions, or even this expansive definition of broker, which I think, goes too far and is very concerning. This is doing what we did with cash, was saying, hey, those institutions don't work in creating the monitoring that we need for this. Therefore, we need to impose this information collecting and reporting provision on end users, which is the general public. And again, it's framed in terms of whether you have a trade or business, but with digital assets, that's just much broader than is practically speaking the case with physical cash.
All right. Well, listen, this has been a enlightening episode. I hope this gets a lot of play because I think a lot of people need to hear this message. Thanks for coming on the show.
Excellent. Thanks, Eric.
And if people want to learn more about you and what you're writing, where can they find you?
Well, I'm working on something else to get out there soon. I've got one article out there on tax notes, which introduces the issue. Really, my goal now is to give some of the raw materials and understanding of the statute so that others can spell out the consequences and communicate these. I'm not a lobbyist or political activist by inclination or anything. I'm hoping that people kind of see the basic issues and then can help spell that out further. So I should have another article out soon. But hey, people should just look at the bill. Look up 26 U.S.C. 6050I and see what that means once that includes digital assets. Ask questions and start spelling out what the consequences for this would be on the American economy, on this whole area for innovation and for their own business practices. What does it mean? What would it mean for you if you need to track your receipt of digital assets in a way that might lead to a requirement to report those transactions to the government? That's what's lacking here. And so hopefully we can get some attention so that other people can fill out those consequences.
Great. Thanks so much, Abe. It was excellent to have you on the show.
Thanks, Eric.